Hey everyone. If you're a retail investor watching your portfolio lately, you already know that global uncertainty is running incredibly high right now. And listen, when the Reserve Bank of India makes a massive $5 billion move, well, that ripples straight into your investments. So in today's explainer, we're going to decode this massive RBI swap and figure out exactly what it means for the broader economy and, more importantly, for you.
Here is our quick roadmap for today. We'll start with the falling rupee. Then we'll be decoding the swap auction. After that, we'll look at the ripple effects on the market. And finally, we'll ask the big question, is this enough?
All right, let's jump right into part one, the falling rupee.
Think about this single glaring number for a second, 7%. The Indian rupee has dropped a staggering 7% so far this year. Now, for a retail investor, this isn't just some abstract economic figure floating out in the ether. A depreciating currency literally makes imports more expensive, which drives up domestic inflation, which can ultimately eat right into corporate profits and hit the stocks you're holding in your portfolio. This 7% drop is exactly why you need to care about what the RBI is doing today.
And it's not just dropping, It is severely underperforming its peers. Experts have recently called it the weakest and worst emerging market currency in Asia. Just think about that contrast for a moment. India is an absolute economic powerhouse, yet its currency has been hitting record lows day after day compared to much smaller regional neighbors. Now, sure, while India does some trade in rupees with neighbors like Bhutan, Sri Lanka, and the Maldives, the US dollar is still the undisputed heavyweight of global trade. This constant daily depreciation is the exact crisis forcing the central bank's hand.
Moving on to part two, decoding the swap auction. So, what exactly is a buy-sell swap? Well, it's a mechanism where the RBI injects long-term rupee liquidity into the banking system by buying dollars from banks right now and agreeing to sell them back later. Honestly, think of it almost like a massive 3-year pawn shop transaction for banks. They hand over their dollars as collateral to get a huge infusion of rupees today. This specific $5 billion intervention has a 3-year tenor. That means the banks get their dollars back 3 years from now. The primary goal here is just to ensure adequate long-term cash is floating around in the financial system. The timeline here is absolutely crucial because the RBI is essentially hitting the pause button on liquidity panic all the way until 2029. The auction itself is scheduled for May 26. Then look ahead to the settlement date on May 29, 2026. Finally, the reverse leg of this swap, where the whole trade is undone, matures in May 2029. So you see, this is not just a quick overnight fix. It's a calculated multi-year lock-in strategy to really support the market.
Let's break down the math real quick. Step 1, banks hand over $5 billion today. Step 2, the RBI hands back rupees. At roughly 9 crore per million, that is an instant, massive injection of 45,000 crore rupees straight into the domestic banking system. Wow. And step 3, in 3 years, they reverse the whole thing. So by executing this today, the RBI triggers an absolute explosion of much-needed domestic cash overnight.
All right, part 3, ripple effects on the market. Let's see how this plays out. There are 3 direct benefits that happen almost immediately. First up, it reduces forward premiums, which are essentially the hedging costs in the market. You can think of forward premiums as insurance costs against currency fluctuations. This move makes that insurance much cheaper. Second, when rupee liquidity is ample, it gives the RBI the breathing room to intervene directly in the foreign exchange spot market by selling dollars to stabilize the currency. And third, because of these actions, the rupee tends to get stronger, at least in the short term. We actually saw a similar move last year when a $10 billion swap helped the rupee briefly appreciate from around 87.5 to 85. Now, let's connect the dots from central banking directly back to your portfolio. Cheaper hedging costs directly aid corporate margins for importers. When the currency weakens, importing companies face skyrocketing costs, right? But by reducing those forward premiums, this RBI swap acts as a vital financial relief valve. Cheaper imports mean protected profit margins. And what do protected profit margins do? They ultimately support the stock prices of the companies sitting right there in your investment account. Which brings us to part 4. Is this enough? Let's look at a direct contrast here. Today's current swap raises $5 billion, which experts expect will only yield a minor 50 to 70 paise appreciation in the rupee. Honestly, it's essentially a water pistol. Now, contrast that with the massive 2013 bazooka intervention for non-resident Indians. Back then, the RBI raised $25 to $30 billion, which resulted in a major rupee appreciation, bringing it from 68 all the way down to 61. This historical context is absolutely vital for us to understand just how minor a $5 billion swap actually is in the grand scheme of the global forex market.
And I want to show you a truly mind-boggling piece of macro math from that 2013 intervention to show why these major moves are sometimes so necessary. Raising $30 billion came with a cost, about 2 to 3%, or roughly 8,000 to 9,000 crore rupees. But look at the benefit. India's net oil imports are massive, close to $140 billion. If an intervention saves just a single rupee on the exchange rate, it saves the country 14,000 crore rupees on oil imports alone. Spending 9,000 crore to save 14,000 crore per rupee? That is an incredible return on investment, and it proves that countrywide savings from a stronger currency can easily outpace the massive upfront costs.
So this leaves us with a massive question for your portfolio. Given global uncertainty, is this $5 billion swap just a temporary band-aid? Or is the RBI keeping its real heavy artillery cash reserves dry for a much bigger fight ahead? These smaller measures might strengthen the currency for a couple of trading days or weeks, sure, but major decisive steps will be needed to attract the heavy inflows required to hit a definitive bottom for the rupee. You're definitely going to want to keep a very close eye on the RBI and your portfolio in the coming months. Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you on the next one.